Well, investors sometimes struggle to differentiate between cycles and crises. To make sense of it, we are joined by Alan Greenstein from Alternative Real Estate Investment Manager, Zagga. Alan, welcome back to you.
Thank you very much. Pleasure to be here.
So, what sort of signals do you need to look for when you're talking about whether you're looking at a crisis or it is simply a cycle?
Yes, thank you. We recently wrote a white paper entitled Opportunity Through Uncertainty. And in that, we postulated that what we're really seeing now is a market cycle, not a crisis. And the basis of that exposition was really that in a crisis, what you'd see is massive systemic risk. You'd see huge distress across the market, and you would see an absence of liquidity. And we're not seeing any of that right now. The banks are still well capitalized. Yes, property is much softer, but we're still getting velocity through the market. Property prices are down, but I think the recent numbers from Cotality last week showed that the Sydney market is down 1.4% from its highs, so it's hardly in free fall. Unemployment numbers are holding up, so none of these are the signs of a crisis. These are more the signs of a cycle.
All right, so in other words, in terms of property, you're saying it's more likely to be a correction, potentially healthy, rather than a collapse?
I think what we're saying is what we're seeing is an adjustment. And that adjustment is being driven largely through global factors, geopolitical and macroeconomic, as well as the uncertainty created by tax changes that have been promulgated, which have not yet been legislated, plus obviously cost of living stress through interest rate increases.
When does a turning cycle morph into a crisis? What do you need to look for?
Well, I think you need to ask the economists that. I'm just a simple business person trying to run a private credit business.
But you would be looking at the macro to determine
Absolutely.
what you're trying to get ahead of it.
Absolutely, and I think that what we're really looking at is we're looking at a number of indicators. We're looking at what is happening with employment, we're looking at what's happening with inflation, we're looking at what's happening with clearance rates, and right now what we're seeing is an adjustment. I wouldn't even call it a correction, but an adjustment. Clearly, if interest rates will continue to rise, if property prices will continue to diminish significantly, then we would start to get a lot more concerned that what we're seeing is a market adjustment, a market correction. If that correction continues after that, but as we all know, for a recession, you need consecutive quarters, 3 consecutive quarters of negative growth. We don't have that right now.
So in terms of where we're at then in the credit cycle, how do you see this playing out, particularly as far as private credit demand is concerned?
Yeah, so Andrew, I think that I can speak about real estate private credit more than I can speak about private credit across the board. Real estate is where we focus. I still think there's a lot of opportunity in the market. If you look at the fundamentals, the banks are in the market, but they are pulling back, and that pullback is driven much more by regulatory and prudential factors rather than by appetite factors. Their population is growing and housing supply is not keeping up with population demand. We have a lot of liquidity coming into the market, especially from overseas investors, especially those who've pulled out of the US. And if you can be selective and if you're prepared to back the right asset with the right developer, I think there's lots of opportunity going forward in that market.
How instructive is history, particularly when you look at previous cycles such as what we saw out of COVID?
I think history teaches us lessons that we need to learn going forward, but history doesn't necessarily repeat itself exactly. COVID was very much about liquidity and about contingency planning. I think interest rate rises was very much about being able to manage through sustained extensions and just the sustainability and the stress of continually increasing markets. I think what we're seeing now is about asset selection, is about picking the right assets to back, to finance in the right way, and to do that with a huge degree of discipline and consistency.
We have had an example in New South Wales of a developer having run into trouble in Bathla. Would you say, is that symptomatic of what we're seeing at the moment, or is that more of an anomaly?
I don't believe it's symptomatic of what we're seeing at the moment. I think Bathla, has its own case in point. Perhaps Bathla is impacted by the various factors that are hurting the economy right now. They had a number of projects running at the same time. They had a number of funders out there at the same time. they, like every other developer, are faced with supply chain crises, increases in cost of funding and things like that. But there are many, many, many thousands of developers out there who are doing projects bigger than Bathler's doing, maybe not of the same scale overall, but they're managing to keep their businesses running. So I would like to believe that Bathler is much more endemic to the nature of that particular company itself than to the nature of the market.
So clearly investors need to be aware of the risks. I gather you do have a checklist of sorts of the fundamentals that investors need to be aware of.
Yes, I think checklist is maybe too analytical a word, but there's certainly a number of factors and indicators that we would look at all times. I would suggest that all investors just need to understand what their risk appetite is, and they need to make sure that they invest based on that. But from a funder's point of view, we're clearly always going to be looking at the sponsor themselves. We believe that it's the jockey you should be riding before the horse, and that a good jockey can win on a bad horse, but a bad jockey will never win on a good horse. So let's understand the sponsor first. Then the asset quality has to be good. It has to be the right asset in the right market at the right price where the market is deepest. Then we need to understand, is the builder the right builder? Have we looked at their work in progress? What do the exits look like? So there are many, many factors. I think the real lesson, if I'm going to give anyone any message out there, is that you can't be complacent. You can't look at it as if you've got one loan right, you're going to get them all right. You can't look at it generically. You've got to look at it on a loan-by-loan basis, and you've got to be selective, consistent, and disciplined across all of those loans.